Hey, should you buy a multifamily property that's already producing cash flow, or should you buy one that's a little bit underperforming and then add value so you can maximize your cash flow? If you're wondering what you should do about that in that situation, then you found the right video. Hey, let's jump into the intro, please. Hey, how's it going, friend? Juan, Pablo here. So on this channel, we like to focus on the three pillars to financial freedom, which are personal finance, funding, and real estate investing, with an emphasis on multi-units and multi-family properties. So if you're new, make sure you like, subscribe, so that way the algorithm can do its thing to provide you with additional videos to help you along your journey towards financial freedom. So without further ado, let's dive into the topic. So today's video, we're going to do somewhat of a comparison of how a property is currently performing from a yield play perspective, meaning is already yielding cash flow day one of closing. Meaning, once you close, you're getting cash flow. All right, means occupied and decent shape, is performing. But then we're also going to look at another comparison in regard to value add opportunity, meaning is there any way that you can add value to this property to make it cash flow even more and get way more bang for your buck and get a greater return. So let's go ahead and jump into it. So I'm going to do a screen share. All right, so here's the deal that we're looking at here. So if you see the deal blurred out or the URL blurred out, again, these are deals that our students are looking at. So we just want to protect that information just in case they decide to move forward with the deal. But I'll let you see two different scenarios, scenario A and scenario B. As I mentioned, scenario A is the yield play. It's already yielding cash flow. So as soon as you close, these are the numbers you should expect to receive in column A. Now in column B, this is the return you should expect to make after you add value, whether you increase the rents, decrease the expenses to make it perform even better, make it more profitable. So let's just take a look at the two. So scenario A, this is a 6 unit, okay? And the gross monthly rent is a little under $5,000 a month. Okay, and we have some operating expenses here. So I'm not going to do a deep dive here. I just want to show you a little bit about how it's currently performing. And we have the NOI, the operating expenses, NOI is there. We think this property is in a 9 cap area, capitalization rate. Okay, 80% LTV for mortgage, the mortgage cover 80%. These are the terms for the mortgage and all that good stuff. So right now it's looking like the total cash flow will be $14,000 and $14,723 for the year, $14,723 for the year cash flow. It looks like the monthly cash flow will be $1,200 or so, with a 17.5% return, which is really good, really sweet. But then we did some additional research and we found that, hey, these rents are pretty much under market, right? Because there's a lot of landlords out there in which they're quote unquote lazy. They might have a good paying tenant, but they just never do rent increases, or they never try to push the envelope where rent's concerned, meaning they don't try to evict the current tenant who's paying less than market rent to get a newer tenant who's paying market rent. Okay, so they're just being comfortable, in other words. So once we did our due diligence on the front end, we found out that, hey, public assistance, yes, even Section 8, they'll pay a lot more, to the point we can receive up to $7,260 if we turn over all these units to tenants who are paying market rent, public assistance. So we just made that one little change. And let's say we kept almost everything else the same. Let's say we increased the property management fees a tad bit, we increased the repairs a tad bit, because of course, if you turn over units and the tenants are leaving, you might have to do some cosmetic repairs, some paint, some carpet, and so forth. So we made a little increase there. All right. And the property insurance, let's say the property insurance is $360 as well. Okay. Now you see the operating expenses went up a tad. So the NOI went up a tad too for the rents. Okay. Now let's just drop down to the cash flow. So you see the cash flow increased greatly, more than double as a result of those rent increases. You see the monthly cash flow went from $1,200 to over $3,000 with a huge return of 43%. So to answer the question in the beginning, should you focus on yield plays or value plays? Focus on yield plays and make them into value plays. And that's what we show you how to do at 100% Finance. So if you're interested in learning more about how to acquire multifamily properties, whether it's in your backyard or out of state, as well as how to obtain and using creative financing, OPM, other people's money, then make sure you check the link below in the description to learn more. As always, guys, this is to your success. Continue to earn passively, live passionately. Peace.